Sometimes it's too good to be true. There's a reason why it's too good to be true. We just don't do things to cause pain to ourselves. Valuation drives the bus for me. It determines, do I go in at this price, wait for a better price? What if this happened or that happened? What would the valuation be? For me, the risk is always going to be the underlying business. We are very unique in what we do in terms of the research, in terms of the strategy itself, because when we're hedging a position, we're limiting the upside. And I'm okay in saying that. The extra protection for the sacrifice of upside, I'm okay with that trade-off. But I feel like a lot of other funds, when they find a company they make an investment in, it's 50 right now, they think it's worth 100. To sell it at 65 or 70, to them, feels like it's a loss. Mentally, for them, it's like, oh, we left money on the table, selling it so early, prematurely, if you will. Whereas with us, we're okay with that. And I think that's what really separates us from them. I certainly wouldn't say that it's better, because I think everybody has their own way of managing it. Some funds may go up and down a lot more volatility on a monthly basis. At the end of the year, they're 10 points better than us. But that's not what we do, though. We're a much different way of doing things. I joke about this. If I could rename my fund, I would rename it Avoidance Capital, because we just don't do things to cause pain to ourselves. The direct correlation to us being investors, me, my chief operating officer, the other principal of firms, all being invested in a fund, it's such a real, tangible scarlet letter, if you will, that's burned into your chest to know that, hey, it's not worth it. Really, A, don't do anything stupid. B, it's not worth it. I think the first thing is look at the management team. That's so important, because these are the people you're allocating capital to. Are they trustworthy? Are they capable? Do you believe in their ability? Do you believe in their plan in growing your capital? Because, again, you're allocating your capital to somebody else to manage. When you're buying shares of a company, it's the same thing as you investing in a business privately. You have to believe this person has the right moral compass to do the right thing, to do what's best for the shareholders. I mean, the second piece is their underlying business. Is it secured? Is it safe? Because the world changes so quickly and so fast. I grew up with the telephones with a rotary dial, the press button. My first cell phone was a Nokia. Has anybody seen a phone from Nokia or Ericsson in the last 5 years, 7 years? And they used to dominate the market. So for me, the risk is always going to be the underlying business. Being a father just changed my profile so much. I think the first part is you want to come home to your children. Everything that I do for my 2 boys. And I want to make sure they're always taken care of, which is why transcends into, again, direct correlation to my risk. I don't want to do something that would endanger their future financially. And that's really, really heavy weight, but it's fine. It's fine. So the framework of constructing my portfolio holdings, it starts from the top of 2 paths. The first path is going to be when I find a theme, a thesis that I believe in. And depending on the conviction of that theme is how I invest in it. For example, in the spring of 2021, when everybody was talking that inflation was dead, using that word, transitory, I was writing in my quarterly newsletters and communicating to our LPs that no, inflation is here. It's here. It's going to be here. And when that happened, when I believed that, I started looking to all the sectors and industries that benefit from a higher interest rate, which was the financials, the insurance companies, the asset managers who capture the spread, if you will. The second path is when I find a very special situation that I truly, truly like a lot. And when I go in a situation like that, I look at, again, the management team. I look at the business itself, underlying business, the good, the bad, the ugly. And usually at that point, I started limiting across of a lot of companies. Then I go into the financials, the balance sheet, their cash flow. I'm a very big cash flow person. I'm not a big fan of the EBIT, the EBITDA, the GAAP, the non-GAAP measures. For me, cash flow tells the better story for me. And right there, again, it's where I probably eliminate a lot more companies. At the end, then becomes a question of valuation. Valuation drives the bus for me. It determines, do I go in at this price, wait for a better price? What if this happened or that happened? What would the valuation be? And the odds valuation determines how I want to structure the options component of it. Two examples. Let's say stock's worth is trading at $50 a share. On the first example, I think stock's worth $100 a share. I may sell options at $70, $75, $80. I don't give up that much of an upside. If the second scenario, the stock's trading at 50, but I think the fair value is 75, I may sell options at 55, 60, 65, 70, 75. I may even take a small position also. So valuation does drive the bus for me. And that determines also my exit also, the valuation. Exit also is being determined by did anything change in the company fundamentally. Whether the stock price go up and down doesn't really bother me as long as I know that the story is intact. I have at times been long a security. I actually hope it goes lower. And it may sound strange to someone watching this and say, they may question, well, you're long the security. If it goes down, you'll lose money. Yes, that is true. But I have every belief that it will go higher and then some. So the opportunity to buy a stock at a lower price is great for me. As far as how we implement our risk measures, I'm not so sure if it is different than what other funds do. I do think the one difference between us is that when we have positions that may suffer a drawdown because of the market's reaction, not because it's company specific, we're not going to panic out of the position. I think the second piece may be different, but I'll just speak only for us, is that we typically have a significant amount of cash on our books. We keep cash because in case the markets suffer a drawdown, we're able to add new positions if we feel it's a good time to do so. We're not forced to sell something that's gotten cheaper, that's at a lower price, to buy another position that's also cheap. Again, I recognize that when you're sitting in cash, it's not being put to work, your performance is affected by that. Because when the cash at work, you could put to work and potentially generate more alpha. But for me, that cash cushion gives me a peace of mind. It allows me to not worry the direction of the market, not worry that I'm not going to have opportunity to take advantage when things are on sale. In our industries, it was a memorable loss. The one I mentioned before. That was probably the most memorable loss that we suffered. What I learned from that really was the courts are, especially in California, they're just a wild card. And I think number two is that when I bought in our industry, I had almost a 100% discount to net asset value. Sometimes it's too good to be true. There's a reason why it's too good to be true. And I should be more skeptical of it probably. had that early on issue with the regulator in New York, it really helped me understand the dynamics of the hedge fund industry. One of the issues they had was that we had a couple of slides in our marketing deck that while we believe everybody could understand it, we weren't literal enough. We were happy to understand that process and ensure that going forward that all of our marketing materials would be as literal as possible. There was an investment that I thought that it was just a terrific investment. I felt really solid about it. Unfortunately, it didn't turn the way it turned out to be. Fortunately for us, we still made money on it. It was a company called Apcelera, a clinical company for biotechs and pharmaceutical companies. They used different technologies to help biotechs and pharmaceutical companies invent drugs, assist them through the trials. And I just fell in love with that technology. They had many partnerships with major biotechnology, with major pharmaceutical companies. Unfortunately, the one thing I missed was that the management team was spending a lot of money on building a new facility. They were doing things that a major pharmaceutical company would do. They were building an empire, except they weren't the king. So all those things they've done took away their focus on what is important to grow the company. And we got out of it. Fortunately for us, we still were ahead because when we bought the company's shares, we saw option against that. The premiums received from selling options offset the loss in the stock itself.